Amazon says a server lasts 5 years. Microsoft says 6. Michael Burry says 2. Same box, same chips. 3 different answers. That gap is not a rounding error. Depending on which answer you believe, big tech's reported profits over the next 3 years are either roughly right or overstated by more than 20%. By the end of this, you will know exactly where that number hides in a filing, how to check whether a company has moved it, and which one of these companies just quietly admitted it got the answer wrong. This is the first in a series we are calling One Number. Each one takes a single line in a set of accounts, shows you the machinery behind it, then shows you what it is doing right now to real companies. We are starting with depreciation, because it is the most boring word in finance and currently the most important. Around $467 billion of computing equipment is sitting on hyperscaler balance sheets. How fast that pile gets written down is a choice, and that choice lands straight in profit. Start with the machinery, because once you see it, you cannot unsee it. A company buys a server for $60,000. It does not take that as a cost on day one. It spreads the cost across the years it expects the machine to earn its keep. Assume 4 years, and you book $15,000 of cost a year. Assume 6 years instead, and you book $10,000. Same machine, same price, same electricity bill, but this year, $5,000 of cost simply did not appear. It did not vanish. It moved into the future. Now multiply. Do that across $100 billion of equipment, and you have manufactured billions of dollars of profit without selling anything extra, without cutting anything, and without a single new customer. No cash changed hands. Nothing about the business improved. A number in a footnote moved, and earnings went up. So the obvious question is whether anyone actually did this. All 4 of the biggest spenders did it, within about 18 months of each other. And the amounts are not small. Microsoft went first. In its 2023 financial year, it reassessed its servers and stretched them from 4 years to 6. The benefit that year was about $3.7 billion. Alphabet followed in January 2023, servers from 4 years to 6. Depreciation fell by billions, and roughly $3 billion of it landed in profit. Meta has been walking the same road for longer, about 3 years back in 2020, then 4, then 4.5, then 5, then 5.5, effective January 2025. That final step on its own was worth $2.9 billion, close to 4% of its pre-tax profit. And Oracle, the subject of our last video, went from 4 years to 5, and then to 6. Add it all up, and one estimate puts the suppressed depreciation at around $200 billion through 2028. Michael Burry's version of the same sum is $176 billion between 2026 and 2028, and he argues it means profits are overstated by more than 20%. Here is the first thing worth taking away. Every one of those companies beat expectations in years when this change was helping them, and not one of them broke a rule. Every move was legal, disclosed, and signed off by auditors. That is the uncomfortable part, because there is a real defense here, and it deserves a proper hearing. Under the accounting rules, useful life is not a number handed down by a regulator. It is management's best estimate of how long an asset will keep earning. It is meant to be specific to the company. 2 firms can look at identical hardware, land on different answers, and both be right. And the case for extending is not absurd. Older chips do not stop working. They get moved off frontier training and put to work on inference, on internal jobs, on the cheaper tiers. A processor too slow to train the next model can serve customers profitably for years. Cooling has improved. Utilization is managed better than it used to be. The honest position is that nobody outside these companies has the data to settle it. Useful life really is a range, not a fact. But there is one way to test what a company actually believes, not what it says in an interview, what it does when the answer costs it money. And in February 2025, one of the 4 did exactly that. It moved its estimate in the direction that hurt. It is the single most informative thing that has happened in this entire argument, and almost nobody covered it. Amazon had been extending, like everyone else, servers from 4 years to 5 in 2022, worth $3.6 billion of avoided depreciation. Then from 5 to 6 in 2024, worth about $3.1 billion added to operating income. Then it stopped and reversed. Effective January 2025, Amazon cut the useful life of a subset of its servers and networking equipment from 6 years back to 5. The reason given, in its own filing, was the increased pace of technology development, particularly in artificial intelligence and machine learning. That decision cost Amazon around $700 million of operating income in 2025. It had already taken a $920 million accelerated depreciation charge the previous quarter for equipment it was retiring early. Sit with what that means. The company running the largest cloud fleet on Earth, the one that can see precisely how long its own hardware stays useful, looked at its own data and concluded that AI is making equipment obsolete faster, not slower. And it took $1 billion hit to say so out loud. Everyone else, looking at the same industry, at the same time, went the other way. Which brings us back to the 3 answers we started with. Amazon says 5 years, and it is paying real money to say it. Microsoft, Alphabet, and Meta say 6 or 5.5, and they are collecting real profit for saying it. Burry says 2, and he is not the one who has to file the accounts. Our position is this. Nobody watching from the outside knows the true useful life of one of these machines. But when the operator with the best data moves against its own interest, and the rest of the industry moves in favor of its own interest, that asymmetry tells you more than any of the arguments do. It does not mean the profits are fake. It means a meaningful slice of reported AI profit is an assumption rather than an outcome, and assumptions get revised. So, 3 things to carry out of this. 1. Useful life is a choice, not a fact. Stretching it lifts profit today without $1 extra of revenue. 2. 4 of the biggest spenders stretched it between 2022 and 2025, worth roughly $3 billion a year each at the peak. 3. Amazon went the other way and paid for it, and it is the only one of the 4 with nothing to gain from that decision. The number itself sits in the property and equipment note. Search any filing for the words useful life. If it moved, ask what moved with it. One last thing. On September the 8th, Oracle reports again. Its depreciation assumption has already moved twice. Watch whether it moves a 3rd time. Next in this series, the number that makes a company look like it is growing when all it is really doing is shrinking. Share it. Subscribe for the next one.